On March 5, 2013, Toronto's financial district watched as Target Corporation rang the opening bell for its Canadian expansion. Within 24 months, the Minneapolis-based retailer planned to operate 124 stores across Canada. Wall Street analysts projected billion-dollar revenues. The Zellers acquisition created instant real estate dominance. Canadian consumers lined up for the American retail experience they had crossed borders to access. Fast forward to January 2015. Target announced the complete shutdown of Canadian operations, posted a $2.5 billion write-down, and abandoned 133 stores simultaneously. The company was now hemorrhaging cash, laying off thousands, and executing one of the fastest corporate retreats in retail history. This is the story of one of the most spectacular international failures in business. But the warning signs were there from day one. To understand how Target burned through billions in under 2 years, we need to go back to the boardroom decision that started it all. Target's story does not begin with the Canadian expansion disasters. It all started in 1962 in Minneapolis, Minnesota, when George Dayton launched Target as the discount retail division of his Dayton Company. His revolutionary vision was upscale discounting, combining low prices with better design and a better shopping experience. The early Target was a masterclass in retail innovation. While competitors like Kmart focused purely on rock-bottom prices, Target pioneered the concept of cheap chic. They transformed discount shopping from a purely utilitarian experience into something aspirational. Their stores were brighter, cleaner, and more organized than the competition. Their merchandise was not just affordable, it was tasteful. By the 1980s, they had perfected their formula: trendy products at discount prices in clean, well-lit stores that did not feel like discount stores. Target stores did not have the cluttered aisles and fluorescent harshness of Walmart or Kmart. They created an atmosphere where trendy, middle-class shoppers did not feel embarrassed to be seen. Their most brilliant innovation was the red bullseye logo and the "Expect More, Pay Less" slogan that became synonymous with accessible luxury. That simple red target communicated both affordability and precision, hitting the sweet spot between quality and price. Target did not just sell products, they sold aspiration to middle-class America. They convinced shoppers they could have designer aesthetics without designer prices. This spirit of innovation defined Target for decades. They were retail pioneers in designer collaborations, bringing high-fashion names like Isaac Mizrahi, Missoni, and Jason Wu to the mass market. They revolutionized store layouts, pharmacy integration, and the big box shopping experience. By 2000, they had grown to over 1,300 stores and $36 billion in annual revenue. But their success was built on understanding American consumer psychology, American supply chains, and American retail real estate. Everything that made Target work was deeply rooted in the US market they had spent 50 years mastering. From 2000 to 2010, Target's growth seemed unstoppable. Revenue doubled from $36 billion to $67 billion as the company opened hundreds of new stores and expanded into grocery retail with their Super Target format. They became America's second-largest discount retailer, trailing only Walmart, but commanding premium pricing through superior brand positioning. Target's merchandising strategy was brilliant. They understood that American consumers would pay slightly more for better design and a better shopping experience. Their stores carefully balanced essentials with impulse purchases, creating the famous Target effect where shoppers entered for toothpaste but left with $200 of home decor, clothing, and electronics they did not know they needed. The company was not just profitable, it was becoming a cultural icon. This success caught the attention of Canadian consumers, who would regularly cross the border for Target runs. Canadian shoppers spent an estimated $1 billion annually at US Target stores, creating long lineups at border locations in Buffalo, New York, and Detroit, Michigan. Canadians would make special trips just to shop at Target, often filling their cars with merchandise unavailable at home. The Red Bullseye had become an aspirational brand for Canadians tired of limited retail options. This cross-border shopping phenomenon revealed a massive opportunity. Canada represented 35 million potential customers with higher disposable income than typical American consumers. Canadian retail was dominated by aging chains like Zellers and The Bay, leaving room for disruption. The country had few true discount retailers that offered stylish merchandise. For Target executives, Canada seemed like the perfect first international expansion, close enough culturally and geographically to minimize risk, but with significant UN-met consumer demand. 2011 was the year Target made its most ambitious move. They acquired the lease rights to 220 Zellers locations from Hudson's Bay Company for $1.8 billion. This wasn't just an expansion, it was an invasion. The deal gave Target instant access to prime real estate in major Canadian markets from Vancouver to Halifax. Rather than gradually entering the market with a few flagship stores, Target would become a nationwide retailer overnight. Wall Street was ecstatic. The Canadian expansion was projected to generate $6 billion in annual revenue within 5 years. Target's stock price surged on international growth prospects. Analysts called it the most significant retail expansion in North American history. Target executives promised the Canadian stores would be profitable by the end of their first year of operations. The company's CEO, Greg Steinhafel, called it a historic milestone that would transform Target into a global retailer. By early 2013, Target had committed over $2 billion to the Canadian venture, renovating stores, building supply chain infrastructure, and hiring thousands of employees. The company projected 124 to 135 stores would be operational by the end of 2013, with plans for 150-plus locations by 2015. The first wave of stores opened in Ontario in March 2013, with expansion plans for Quebec, British Columbia, and the Prairie provinces shortly after. Canadian media covered the openings as major events, with consumers camping overnight to be first through the doors. The first signs of trouble appeared in March 2013, ironically the same month as the grand opening. Early shoppers who had lined up for hours expecting the full American Target experience were met with empty shelves, limited product selection, and prices significantly higher than US locations. The disappointment was palpable. Canadians who had driven to US Target stores were shocked to find the Canadian version was a pale imitation. Canadian Target stores were consistently understocked, sometimes operating with only 60% of shelf space filled. Products that Canadian consumers had specifically crossed the border to buy were either unavailable or priced 20 to 40% higher than US locations. Basic items like toilet paper and detergent were frequently out of stock. In some locations, entire departments looked abandoned, with bare shelving and missing inventory. Social media erupted with disappointed customers, sharing photos of barren aisles and comparing prices to their US shopping trips. The hashtag #TargetCanadaFail began trending within weeks of opening. Consumers who had eagerly anticipated Target's arrival became vocal critics. One shopper tweeted, "Target Canada, all the emptiness of Zellers but with the prices of the Bay." Even more concerning were internal metrics that Target tried to downplay. Store traffic was lower than projected, and average transaction sizes were not meeting forecasts. The stores that were supposed to be generating millions in revenue were struggling to cover their massive overhead costs. customer satisfaction surveys showed alarming dissatisfaction. Repeat visit metrics were disastrous. Shoppers were not coming back after their disappointing first experiences. By summer 2013, it was clear that the Canadian launch was not meeting expectations, but Target publicly maintained optimism while privately scrambling to address supply chain and pricing issues. Company statements emphasized growing pains and promised improvements, while executives held emergency meetings about the worsening situation. Target Canada wasn't just facing one problem. It was a perfect storm of strategic miscalculations, operational failures, and market misunderstanding that compounded into catastrophe. First, the supply chain disaster. Target had built their Canadian supply chain from scratch, constructing 3 massive distribution centers in Ontario, Alberta, and Quebec. Unlike their mature US system that had been refined over decades, the Canadian infrastructure was plagued with problems from day one. These warehouses used different technologies and processes than their US counterparts. Instead of gradually scaling up operations, they were expected to handle nationwide volume immediately. The company's SAP software system, designed to manage inventory and pricing across stores, was catastrophically buggy. Products would show as available in the system, but be out of stock in stores. Pricing data was inconsistent, leading to products being marked up arbitrarily or not arriving at all. The database contained thousands of errors, wrong dimensions for products, incorrect case pack sizes, and phantom inventory that didn't exist. Former employees revealed that the distribution centers were operating at only 30% efficiency compared to US facilities. This meant that even when products were ordered correctly, they often didn't make it to store shelves. Trucks would arrive at stores with partial shipments or entirely wrong merchandise. One store manager reported receiving 1,000 toasters when they had ordered just 10. Another described receiving Christmas inventory in January and summer products in October. Second, the pricing problem that Target could never solve. The company had promised Canadian prices would be competitive with US locations, but the reality was far different. A combination of higher Canadian taxes, import duties, currency exchange rates, and the cost of building new infrastructure meant Canadian prices were consistently 20 to 40% higher. When a basket of goods cost $100 at a US Target, but $135 at Canadian locations, the value proposition disappeared. Canadian consumers, who were already accustomed to higher prices, were not willing to pay premium prices for an inferior shopping experience. Many complained that Target Canada was more expensive than existing Canadian retailers like Walmart Canada and Canadian Tire, without offering any additional value. Third, Target fundamentally misunderstood the Canadian retail landscape. They assumed Canadian consumers were identical to Americans, just with different currency. But Canadian shopping patterns, seasonal preferences, and brand loyalties were distinct. Canadians expected different product assortments, particularly in grocery, clothing, and household goods. Canadian consumers were more loyal to established Canadian brands and less interested in some of the designer partnerships that had made Target famous in the US. The cheap chic positioning that worked perfectly in America felt foreign and overpriced to Canadian shoppers. Target's private label brands, which drove significant profit margins in the US, were unknown to Canadians and could not command premium pricing. Fourth, the real estate trap that became a financial anchor. The Zellers locations that Target had acquired were in prime spots, but they were configured for a completely different retail model. Converting them into Target stores required massive renovations, often costing $2 to $3 million per location. These renovations created beautiful spaces, but saddled each store with enormous fixed costs that required high sales volume to justify. Many former Zeller's locations were also too large for Target's inventory levels, creating stores that felt empty and uninviting even when fully stocked. The lease commitments locked Target into expensive real estate regardless of performance, and they could not easily downsize or relocate underperforming stores. Each location became a financial millstone around the company's neck. By late 2014, internal documents revealed the scope of the disaster. Same-store sales were declining quarter over quarter. The average Canadian store was generating less than $30 million annually, compared to $40+ million for comparable US locations. With higher operating costs and lower revenue, most Canadian stores were operating at significant losses. Target was hemorrhaging cash with no turnaround in sight. By late 2014, things were looking catastrophic for Target Canada. The company was burning through cash at an unsustainable rate, with quarterly losses exceeding $200 million. Despite nearly 2 years of operations and multiple attempts at fixes, the fundamental problems were getting worse, not better. Initial optimism had given way to grim reality. In December 2014, Target brought in consultants to conduct a comprehensive review of Canadian operations. The findings were devastating. There was no clear path to profitability. Even the most optimistic scenarios projected years of losses before potential break-even. The consultants estimated that Target Canada would not generate positive cash flow until 2021 at the earliest, and would lose billions more in the interim. Target faced a brutal choice: continue pouring hundreds of millions into a failing venture, or cut their losses. The parent company had already invested over $7 billion in the Canadian expansion when factoring in acquisition costs, capital expenditures, and ongoing operational losses. Every month of continued operation was costing tens of millions with no improvement in sight. On January 15, 2015, Target made the shocking announcement that would end one of retail's most expensive experiments. The company announced it was discontinuing all Canadian operations immediately, closing all 133 stores and laying off 17,600 employees. The decision was not gradual. It was sudden and complete. Target would liquidate all Canadian inventory and exit the country entirely by April 2015. The financial devastation was staggering. Target reported a pre-tax loss on discontinued operations of $5.4 billion, including $2.5 billion in fourth-quarter write-downs alone. This was not just a business failure, it was one of the most expensive corporate retreats in history. The company had spent more money failing in Canada than many successful retailers generate in annual revenue. The closure process was as chaotic as the expansion had been. Liquidation sales drew massive crowds, but also highlighted how little quality merchandise had actually been available during normal operations. Employees received minimal severance packages, and suppliers were left with millions in unpaid invoices. Many vendors who had eagerly partnered with Target found themselves facing financial distress from unpaid receivables. Within 90 days, the red bullseye logo was gone from the Canadian retail landscape entirely, leaving behind empty big-box stores and a cautionary tale about international expansion gone wrong. Some locations remained vacant for years afterward, creating retail dead zones in malls and shopping centers across the country. So what went wrong? 5 critical failures led to Target Canada's spectacular collapse. First, operational arrogance. Target assumed their successful US formula could be transplanted to Canada without significant adaptation. They underestimated the complexity of building supply chain infrastructure in a new country, and they overestimated their ability to execute flawlessly from day one. Target executives believed their existing systems would work perfectly in a new market, without recognizing the countless small adaptations needed for international success. Second, the pricing death spiral. Target promised competitive pricing, but could not deliver due to structural cost disadvantages. Rather than adjust expectations or find creative solutions, they trapped themselves between unprofitable low prices and uncompetitive high prices. They failed to build a unique value proposition that would justify premium pricing in the Canadian market. Third, a cultural misreading of the market. Target never truly understood Canadian consumers or competitive dynamics. They assumed brand recognition from cross-border shopping would translate to loyalty for a different shopping experience at higher prices. They failed to recognize that Canadians who shopped at US Target stores were specifically looking for American products and American prices, not a Canadian interpretation of the Target experience. Fourth, a scale miscalculation. Opening 133 stores simultaneously created impossible logistics and management challenges. Unlike successful international retailers who test markets gradually, Target committed to massive scale before proving the model worked. They should have opened a handful of flagship stores, perfected operations, and then expanded gradually. Fifth, the sunk cost fallacy. Once problems became apparent, Target continued investing in fixes rather than acknowledging fundamental flaws. The $2 billion investment became a psychological trap that prevented rational decision-making until losses became unbearable. Executives kept believing they could fix the Canadian operation when the evidence suggested otherwise. Target Canada's failure demonstrates that retail success is not just about brand recognition or product selection. It is about execution, local adaptation, and understanding that international expansion requires patience and humility, not just capital and ambition. The failure also highlighted how quickly modern retail operations can collapse when supply chain and pricing fundamentals are broken. In an era of social media and price transparency, there is no hiding operational incompetence from consumers. Target could not control the narrative when thousands of disappointed shoppers were sharing their experiences online daily. The Target Canada story is more than just a retail case study. It is a masterclass in how overconfidence can destroy billions in shareholder value and thousands of jobs. It shows that even successful companies can fail catastrophically when they forget that different markets require different approaches. Most importantly, it demonstrates that in retail, execution trumps everything. Brand recognition, financial resources, and prime real estate mean nothing if you cannot get products on shelves at prices customers will pay. Target's Canadian collapse remains one of the most expensive business lessons ever recorded, and its warnings echo through every boardroom considering international expansion today.